Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy the program, give us a like and subscribe. Let YouTube's algorithm know. My guest today is Alex Manson of SC Ventures, based in Singapore. He runs an interesting group that is a different take on corporate venture and startup incubation across different areas of fintech, from digital assets to supporting SMEs. I spoke with Alex about building out all of these different fintech propositions, the business models around them, and the biggest question, will this actually transform the incumbent bank? Alex Manson, welcome to DigFin VOX.
Thank you. Thank you.
Pleasure to have you. You're helping run SC Ventures. This has been going on for about 4.5 years. It's not exactly corporate venture capital. It's got some elements of that, but you're also more fostering your internal entrepreneurs and helping them spin out fintechs out of the bank, and you're backing them. So kind of experimental. What have you learned in that 4.5 years?
Perhaps the first thing we've learned is that if we were to be a quote unquote normal one, meaning either one of run a lab or run a fund that invests in fintech, these efforts would probably fail. And there's a lot of reasons why that might be the case, and we could, we even write op-eds and PhDs on it. But the point being, facts speak for themselves, right? Very few, some of the best labs in corporate history actually didn't manage to change the corporates that were their sponsors, and we see plenty of large corporates, including but not limited to banks, that have been investing for quite some time, and again, that generated perhaps attractive returns, but not a corporate, let alone an industry transformation. So that is perhaps the first learning is that we had to do something different, and the something different is the bet we're making essentially is that the combination of working inside the bank, corporate for us is the bank, and outside in the same time gives us a better shot at achieving transformation. So inside the bank, we run a lab, we have intrapreneur, as you said, in running, as part of an intrapreneur program. We have a fintech bridge platform where we engage with fintech with real use cases, and number of members. In fact, 2,500 members are offering ideas and solutions for company use cases that we put on the portal, etc. All this is what I'd characterize as an innovation lab, and then outside is where we build ventures that are independent companies essentially, and we typically start them from scratch. Not always. Typically we back them initially, although at times we start them as joint ventures. We'll bring in third-party investors sooner rather than later to help us scale, help validate the commercial proposition and all that. And at this point, we've built some 30 ventures that are at different stages in the cycle. And it is that combination of working inside and outside the corporate that we think gives us a lot of transformation power. And yes, of course, we also deploy capital, and as part of building ventures, we deploy capital, but we also invest in the partners we work with, be it in the context of the bank or in the context of one of the ventures that we're building.
Do you have enough history now to say that, yes, this is moving the needle in terms of transformation of Standard Chartered Bank itself?
Yes and no. So yes, in the sense that we have, without a doubt, changed a number of things within the bank. So the bank strategy looks a little different, not massively different, but it looks a little different today than it was some time ago, very much partly on the back of some of the ventures and ideas which we've launched. And so that is a great thing. And so for example, mass retail via partnerships using banking as a service is not something that the bank was doing. Not so long ago, our bank, including most other banks, would have been looking at cryptocurrencies with a very distant look and monitoring development, and we ended up building an institutional grade, not only compliant but bank grade platform for custody and brokerage and exchange, et cetera, et cetera. So a number of things have moved the bank along. I also think that one intrapreneur at a time, the skill building, the talent identification that we do is genuinely changing the bank, and with that I mean culture and mindset and skills building is a very important concept. At the same time, I think the jury's out, right? So when I say intrapreneur at a time, it's a lot of people to ultimately reach, and while I think that the engagement has been absolutely fantastic in a number of pockets of activity, it is definitely too early to say that we've been able to really affect the culture and mindset of the overall bank. And also, I think that a lot of the ventures we're building, while we all have a high level of conviction in them, it's just too early. They're early stage ventures, they're nascent, and it should be expected that some of them will fail. Ideally, some of them will do great, but it's too early to tell. So I think the jury's out in so many ways still.
Yeah.
So
before we talk about some of the ventures, I'd be interested, the classic problem that a lot of fintechs have when they deal with large financial institutions is it just takes so long to get onboarded, right? And they run out of cash before a very large bank might take them on, or they do a POC and they don't get paid, or they don't get paid well, and then it sort of falls apart and they're in trouble. So this is standard stuff. Do you have a different relationship with companies that get spun out of your program? I mean, do they have sort of an inbuilt advantage in dealing with the bank, or do they find themselves in the same queue as perhaps complete third-party fintechs that you might be working with in addition?
Yeah. So first focusing on your contextual point, which is it's normal for fintechs to suffer quite a bit when dealing with large organizations. It takes a long time to get onboarded, and at times we've made the perhaps surprising statement that what it takes to engage with third parties fintechs, I'm not even talking about our own ventures, what it takes is empathy. And empathy doesn't necessarily mean being nice, although I'd like to think we're nice people too, but empathy means understanding what situation that startup is in, and having some appreciation for the fact that it's strapped for cash, and depending on the stage that they're at, it may not be a good idea for them to get in business with you, with a large organization. So at times we'll tell companies that are a little too immature, come back and see us when you have the ability to deal with our onboarding process. Or assuming we were to onboard you and do a POC, frankly, there's no point doing this if you're not going to scale across different markets. And so sometimes the time isn't right, and sometimes we can see, look, the budget isn't there, or there is a champion, but that person is the wrong person, or there's an element of just managing expectations and appreciating that what is just a small option for a large corporate is sometimes a matter of life and death for a small startup. And so the tough feedback, which is not so nice, is at times more helpful. As it relates to our own ventures, I'd like to think they're in a better position than obviously anyone, because we know them by definition. They are onboarded. We know them. In fact, technically, by the way, we have yet to onboard them sometimes, but certainly the degree of familiarity is very different. Having said this, we absolutely insist on them getting their own clients, because we want them to go and get their own commercial validation, and then over time their own investors, so they get their own financial validation. So they're not pet projects of the bank, but they're real companies. And so as such, we'll expect them to get onboarded by other people, go get their own clients, be it in the retail space or in the corporate space, and validate themselves, at which point, of course, the bank is in a position to help them scale in a way that any startup couldn't necessarily do it. Yes. But that's later down the line.
Do you structure any of these deals like a classic venture capital fund, where you've got, say a period of investment into a company, and then an exit path out of that in a structured way?
So two questions. One is the question of the legal structure. The other one is what's the exit. And so question one is we are set up as a fund as it relates to investments in third-party fintechs. We are not, as of yet, set up as a fund as it relates to the ventures we're incubating. Rather, it's a holdco that holds the stakes that we have in the various ventures that we're working with.
Right.
Frankly, you could think of the two options as somewhat equivalent. It's just the way we set it up initially. As it relates to exit, though, it's in the public statements we've made, including to the shareholders of Standard Chartered that backs us. We very much think of this in commercial terms. In other words, should we not be the rightful owners of a venture, then we better sell it at some point and create value for the investments.
And what does rightful owner mean? Alex, sorry, just what does rightful owner mean in that context?
I'll tell you how we think of it at inception, but over time, and just to complete my point, I would say we'd much rather own perhaps a small stake, perhaps less than 20% of a great venture that is very successful and growing very fast, than 100% of a venture that isn't growing and isn't doing so great. And so there's a point down the line where these conversations might happen. At inception, and back to your question, what do you mean being a rightful owner? I'd like to think that with the right backers for the ventures we own, because we have a competitive advantage that any CVC or any VC for that matter doesn't have. Two points. One is we understand Asia, Africa, and the Middle East pretty well as an organization. We have that DNA, and so this is helpful. So we're not building a digital bank in the US, for example, just because we don't really have the right to win there. And two, and I think this is very important, we understand what it takes to operate in a hyper-regulated environment, and there's a cost to operating in a hyper-regulated environment, even if you're only backed by a regulated financial institution that has certain implications in terms of cybersecurity, data security, compliance, etc. And that cost has to be outweighed by the differentiation that we derive from operating in a hyper-regulated environment. Yeah. And where that benefit is greater, we're probably the right backers, because we know what we're doing versus tech companies that may not know what they don't know, right? In the regulated space, and if that cost of operate is not outweighed by real differentiation, then probably without the right backers, and should let some other venture capital firm do it.
Do any of your ventures, your fintechs, do they, at least in the short run, do they suffer competitively because so many fintechs seem built around essentially regulatory arbitrage? A lot of fintechs are more business model innovations rather than actual hard tech. So to that extent, if you're bringing in the Standard Chartered quality of compliance and so on, do you end up sort of risk hobbling some of these ventures early with an overhead?
Definitely a risk, and so for a start, we don't play in regulatory arbitrage. Right. Even if that were to cross my mind, which it didn't, because I don't think that's very sustainable, anyways. But it's not an option, but it's available to us, and so it means it eliminates from the scope a number of areas that could be characterized as such, where we're just not going to play. We're not going to get involved, and so as such, the space is defined, right? But perhaps in a narrow way. I think there is a cost of being backed by us, which, as I alluded to, it means essentially no shortcut in compliance, no shortcut in financial crime compliance, for example. A couple of other things. There's technology resilience, cybersecurity, and other requirements that are expected from us. But and yes, we'll tend to do a little more work upfront with some of the startups than they might have done if they were located in the proverbial garage and having to make up these things as they go. The conviction we have is that these are things that people have to get to anyways at some point in their existence, and so we've advanced them a little bit, but we also have SC Ventures as a platform to some extent, holding people's hands and helping them navigate what the requirements are in the first place and helping them comply with them, which is obviously how we mitigate the upfront cost. And that cost is perhaps one of timing, right? So just initially the startup might be a little less fast.
At the right time.
Business model. Exactly. And again, that better be outweighed by real differentiation, the ability to say, I'm operating at institutional grade, therefore it's completely different from, the offering of fintechs that is in the market, be it, custody for cryptocurrencies, which, I really think Zodiac Custody is the one bank grade institutional great proposition in the market, notwithstanding what other people are saying about themselves. So saying you're compliant on a website doesn't mean much, really. It doesn't equate to institutional governance, and the same applies when we incubate Autumn and people link up their bank accounts. They want to know that Autumn by SC Ventures and Franklin Templeton is a safe place to link up a bank account and upload some financial information, because otherwise we wouldn't be that differentiating from a lot of other platforms.
You've got on your you've organized your ventures along a number of themes. You've already referenced digital assets, financial inclusion, serving small enterprises, virtual banking, and so on. What is there a logic that ties these themes together as you've organized them?
Yeah, the SC Ventures was set up with a purpose to rewire the DNA in banking, which is, it sounds like a mission statement, and like there are many, but we really meant it. There's in my mind, it's a purpose-driven mission statement, meaning we really wanted to reconcile financial services, banks in particular, with society, and fulfill societal expectations of financial services better than the industry has in the years following the financial crisis, so it has everything to do with serving clients in a different way, serving them the way they want to be served, being future ready, and doing things that people expect banks to do, but that banks aren't necessarily doing. So all these themes, be it sustainability and financial inclusion, be it world trade, SMEs, supply chains, be it serving the online economy, be it being digital assets ready, because we think the asset class is here to stay, integrating lifestyle and banking generally speaking, as opposed to having banking for its own sake. All those are themes where we think clients, consumers, corporates, generally speaking, society is expecting us to do a better job as an industry, and where we see an opportunity for us to really build great businesses doing just that.
Yeah. Also, there's some areas that you're not in, brokerage, capital markets, a few areas like that. Could maybe talk about what you think you should not be doing with SC Ventures.
So by the way, I wouldn't necessarily exclude capital markets per se. We've invested in capital markets infrastructure startups, for example, where that are part of our portfolio, and where the use case is within the bank in financial markets. So for a start, one of the things we shouldn't be doing is trying to reinvent a proposition that already exists in the market. If there is a great proposition in the market that we can use, integrate within the bank, and serve our customers this way, this is, just do it. It's the right thing to do, and that's part of what we do at SC Ventures. But that doesn't imply building a venture to do it. Number two, I touched on it earlier. If we're not differentiated as a result of the governance and bank greatness that we bring to the table, then we should let other VCs do it. They're very well equipped, and we're not necessarily trying to compete against them in every space. And then there's just an element of common sense as well, which is do I love health tech or ed tech or agri tech or other areas? I think they're really important to solve real problems that are worth solving. But do we have a competitive differentiation? Do we have the right to win in that space? Are we likely to be higher performing investors than others? Well, not really, because this is not the DNA of us as a group, and so we try and stick to things that are adjacent to the business of financial services, and sometimes that adjacency can be a bit of a stretch, frankly, because we think of it quite broadly or creatively. But there has to be a rationale as to why we understand the space and think we can do a better job than others. With
digital, I guess it's so easy to think a platform you can just bleed into other areas. And I guess part of your discipline is when to go for it and when to hold back.
Exactly. And by the way, today's technology also implies, so we have platforms, we have APIs, we have the ability to plug things into each other. And there's a number of circumstances where we may well have a platform, but frankly, someone else should build the app
Right.
and plug into it. Or the other way around. We have a great banking app and someone else's platform is the right platform to plug it into.
Yeah.
And so an element of understanding where we play and being disciplined about it. Yeah.
Alex, I'd like to ask you a little bit about the digital banking aspect of SC Ventures. So you've got all these themes, the apps you've talked about a little bit, but you've also got two licensed banks, one in Hong Kong, which is a virtual bank, Mox, with some third-party partners. And then in Singapore, you're still, I don't know if you've launched it yet, but Trust Bank with NTUC, which is under Standard Chartered's own license, if I understand that correctly. What's been the difference between these two experiences, particularly one that sort of really you're just a shareholder, albeit an important one, as opposed to one that's sort of using the bank's own license? Can you give us some color in the differences between Mox and Trust and the way that you've approached these two businesses?
Not very much, actually, and I would in some ways downplay the difference between the two licensing regimes, in the sense that they didn't really affect the way we think about it as a business and the way we think about digital banking, generally speaking, which is about having a lifestyle proposition and integrating banking, and in fact digital banking, into people's lifestyles as seamlessly as possible, as opposed to having them sort of pursue parallel tracks. So that is a common point. In both cases, we're building a digital bank which has launched in Hong Kong. It hasn't launched in Singapore, by the way. Just confirming. Stay tuned. It will happen soon this year. But we're building a digital bank, and we want to do this with partners. And they're different in Hong Kong versus Singapore, but in both cases, they're great partners that understand the local economy, have a very thorough understanding of consumers' behaviors and needs, and a great outreach. So Hong Kong Telecom C-Trip in the case of Hong Kong, as well as, or NTUC in the case of Singapore. So they're all the commonalities rather than differences. Then there's an element of tech stack. Tech stack is can be often replicated. Sometimes a little less than engineers would like to think or have assumed initially. But generally speaking, there's some commonalities across both banks, and so some of the learnings in the first experience can apply to the second one. What is fundamentally different, however, is the market where they operate, and this is a bit of a health warning for anyone with a digital bank in one market, thinking, "Oh, great, I could roll it out in 25 other markets next." The technology is just really one part, right? Even the method is really one part. The one thing that is going to be both different every time and critical to success is finding the right product market fit. Meaning understanding a value, coming up with a value proposition that is genuinely relevant in the market where you operate. And it turns out it's different in Hong Kong versus Singapore, and will be different, no doubt, in any other market we attack over time. And this is, I think, a temptation that a large corporate has, which is to sort of standardize everything. I have the same app, and I want it in 55 different markets. And the reality is if you want to approach banking as part of people's lifestyles, then it's going to be different from one place to another, and that's perhaps the main thing to bear in mind.
Given that we're in Asia, why did you decide to pursue virtual banks in the developed city-states of Hong Kong and Singapore, as opposed to trying to do something in one of the large population, big financial inclusion plays?
Oh, so first, they're not mutually exclusive. There's an element of start somewhere. In fact, the digital bank in Hong Kong precedes SC Ventures very much so from an origination perspective, because it was in part triggered by the HKMA opening up the licensing regime and awarding new licenses, and we decided that we really wanted to go for that. So that was at the time, and so the idea was born then. So an element of it's just the way it happened. More strategically, I would say, differentiate between being a digital bank in a market where we're brand already. There's an element of scale that we know we can achieve, and so we really have a business being owning and operating a digital bank, versus other markets where we may not be at scale, our brand may not have the same recognition. Be it the new brand buys SC Ventures or buys Standard Chartered or Standard Chartered itself, right? But generally speaking, where scale and our ability to get to scale isn't the same. And in such markets, we may well want to go via partnerships, meaning find partners and plug banking into their platforms as a way to get to scale, which is the banking as a service model that I've alluded to, which is called Nexus for the bank, and which we're about to launch with Bukalapak in Indonesia, for example. So depending on the nature of the market and our position in such market, we may well play it a little different, but still bearing in mind that none of it is mutually exclusive and those things evolve over time.
Right, because there's this, I guess the strange thing about having these different things is that a virtual bank or digital bank is difficult to scale because it's confined to, the license is confined to that one jurisdiction. Whereas a fintech or a banking as a service platform, that can go anywhere, really, can't it? I mean, some of your at least within bounds. I mean, I think isn't Solve your SME proposition in India? I think they're looking to go to other markets now, and some of these are being able to jump jurisdictions relatively quickly compared to what a bank was. So I'm just curious about how you sort of you've got on the one hand you've got this sort of high capital one jurisdiction kind of a heavyweight proposition, and then you've got a number of, I guess, is a range, a spectrum, but essentially tech companies that can kind of come and go more quickly.
It's a great question and an invitation to reflect on the new economy, really, and banking in conjunction with the new economy, the world of platforms and all that. So first, if you're going to operate a bank, whether it's a platform, if you do banking, you're very likely to be regulated as banking. In fact, if you're not, it's unlikely to stay that way for very long. And so the point of regulation doesn't go away, and that's probably it's probably right. So whether it's a digital bank or banking as a service, when there is a banking service, someone is regulated providing that service. The difference being, I operate the whole channel, meaning the service, the product, the channel in the context of digital bank or banking as a service, where indeed you're very right. The tech stack associated with plugging a bank into a platform, that's not a regulated activity per se. But then again, not a whole lot of banking as a service businesses have the benefit of a regulated financial institution backing them that can plug itself into the platform. So, for example, the tech stack we have developed for that purpose can plug Standard Chartered into Bukalapak, but over time it can also plug any other bank into any other platform. And that other bank would be regulated too, but the technology company that enables to do this can indeed, be replicated. Move around markets, and the proposition can be replicated around the world. Yeah. The e-commerce platform you're referring to in India is actually not a bank; it's a platform. That's a place for SMEs to do commerce together. So that's actually not a regulated activity per se. Happens to be owned by regulated banks, so we're still bank grade, we're still institutional grade, we still have to onboard customers in a bit of a different way, but it's an e-commerce platform. And then we can plug in business services, including, but by the way, not limited to financial services. And when it is financial services, it will include Standard Chartered as a bank, but certainly not to the exclusion of others. In fact, there's another 4 or 5 NBFCs in India sort of plugging into Solve as a platform, and there's another number of banks plugging into the same platform. The former provide BNPL services, the latter provide supply chain financing services, and so these activities are regulated. The platform itself is right. The recipient of these apps. Yeah. Right? So again, a different model. And by the way, you could write the value proposition for Solve. We tested, launched in India. We just launched it in Kenya recently. We're about to announce a couple of other partnerships in Southeast Asia. It's that model can be replicated with nuances. as a function of the market, but it can be replicated across different markets.
Will any of these seek external financing? I mean, will you be at a point where you can do evaluation and say these are unicorns?
Yes, pretty much all of them will at some point. Pretty much all of them will. I mentioned this earlier. We invite third-party investors sooner rather than later. There's a number of reasons to do this. One of them is help us scale. The other one is participate in the commercial validation of the product, but very importantly also the financial validation. In other words, when we say this is worth X, there has to be a market data point that agrees with this or not, and so getting that the valuation is important. There's also an element of ensuring they're real companies with real governance, right? And as much as we build them that way, as soon as third-party investors are in the cap table, the company has to have a governance at board level, which is a proper corporate governance, and in fact, a little different, sometimes very different from internal corporate governance that we might have for a project in the bank, and that's a good discipline to have as well. So for all these reasons, we raise funds for our ventures, and we'll continue to do that.
Alex, I appreciate you coming on to DigFin VOX to speak with me today. What will be the big task for you? We've got about 5 or 6 months left in the calendar year. What will we be hearing from you come the end of the year?
So stay tuned for more ventures seeing the light of the day. We have a number of projects that we've been working on for some time that are testing on the back of the ones that we've announced publicly and weren't quite ready for public consumption. So these will happen. This will come out. We will very likely be in touch with institutional investors and others for fundraising for some of the existing ventures. And it's obviously an important milestone for any of these companies and for us as well as a matter of validation. So that will be relevant. And I think we'll also, and this is perhaps a more internally focused question, but we'll want to think about how we articulate this value creation proposition, this value creation story to our own shareholders, and have the world understand how Standard Chartered is going about this very differently with SC Ventures versus most banks, and what sort of optionality we've created. So I think this is another task of I call it taking the bank with us and all its share and stakeholders, which is an important part of what we need to do as well as we continue to grow.
Great.
So all these things, busy second half. It's
okay. Well, busy's good. Appreciate you making some time to speak with me, and
thank you.
And
thank you.
Great to have you on DigFin VOX.
Likewise. Thank you, Jame. Take care.